Welcome to Financial Coffee Talk with Shane Amy and Shane Swearingen, your planning duo from Shane and Shane Financial.
And welcome into the program. This is Financial Coffee Talk with Shane Swearingen and Shane Amy of Shane and Shane Financial, your resource, ladies and gentlemen, for proactive financial investment and retirement planning, guidance and advice, educational information, common sense approach to planning, breaking down the complex financial issues here on Coffee Talk. Always a pleasure, gentlemen. And Shane, Amy, going to start with you today. I know that we are in the midst of tax season and people are scrambling for those deductions, trying to find ways to pay as little as possible. Of course, we all want to manage taxes and reduce that tax bill. At Shane and Shane Financial, you gentlemen take a little bit of a different approach to proactive tax management. Can you talk about the different approach that you take there at Shane and Shane Financial?
Yeah, I don't know if it's different so much as maybe proactive, but I mean, there's a few different scenarios here. Most of our clients, most people in general have similar problems, right? So, if it's not income that you're after, that typically means you have higher portfolio balances. Maybe you have some golden handcuffs. Maybe you have higher pension plans or a combination of those things. If it's not income, it's usually taxes that folks are worried about, especially, in terms of more high net worth folks. And so, there's a couple of different strategies. There are basically three different types of taxes, right? So there's, your income tax, that's the most popular thing. Those are your 401ks and your IRAs. So you put your money in it, it gets to grow tax deferred. All of your gains, all the money you've put in, everything's tax deferred. The problem is when you go to take it out during retirement, that's income tax. So the second bucket is no tax. Those are, certain life insurance products, Roth IRAs would be probably the most popular thing that people know about. Municipal bonds, like those are all in there. And then the third is, capital tax. So capital gains tax, mutual funds, stocks. And most folks have it in an IRA or a 401k. And so when the tax system got overhauled, a couple of years back, the bands really widened out for taxes. So, like, for example, a couple making, $100,000 a year, they could put an extra $88,000 towards their Roth IRA. In other words, they could move $88,000 from their regular IRA to their Roth IRA. And if you can get ahead of that, that's a huge deal, especially nowadays when, historically our marginal tax breaks or tax brackets, those are pretty low. I mean, the top tax bracket's only 37%. So it's a good idea to try to get ahead of that. I would say once you get north of, I don't know, let's say 2 to 3 to 5 million, you sort of have a different problem, So when you go to take your distributions that the government forces you to take, say at 73 now, right? So it used to be 70 and a half and 73. Maybe we should touch on that. But that, your income could go up hundreds and hundreds and hundreds of thousands of dollars. And so for those clients, we have some more sophisticated options. So, you need to be accredited investor. You would need to, understand, different things. There's different sorts of investments. I don't want to get too in the weeds on that, but just the higher your net worth, the more sophisticated things have to be, and we can certainly handle that there.
And Shane Swearingen, Shane Amy just mentioned getting ahead. During the midst of tax season, a lot of times we're actually looking back. Can you talk about getting ahead when it comes to taxes and what that means for our lifetime tax bill and liability in retirement?
Yeah, as others, Shane mentioned, it's all about being proactive. If you boil it down, there's a couple different reasons or scenarios that people tend to worry about. And it's taxes not only on their new money, so their earned income that they're earning while they're working, but it's also their old money, the money that's already stuck in a 401k or an IRA. And when you start to look at tax liability from the general sense, there should be two strategies, one for your current income And then another strategy for later on in retirement, our country, our government, our economy does a good job of teaching people to defer taxes. And really that stemmed from back in the late 70s, early 80s, when IRAs and 401ks were introduced. The top marginal tax bracket back then was very high in the 65, 70% range. So for all those folks that were working and earning money back then, it made sense to defer all this tax to a later date, where look at where we're at today. We have some of the lowest rates from a historical perspective. So hopefully we continue to stay here, but it's not just as simple as deferring our tax to a later date, because at some point in time, we're going to have to figure out that puzzle too. So it's you really have to balance your taxes on your income and future taxes.
Yeah, this generation, by and large, has saved the majority of their retirement funds, those nest eggs, in tax-deferred accounts under the thinking that we would be paying lower taxes in the future and in retirement. Is now the time to revisit that thinking, that paradigm, and the strategies that we implemented under that pretense?
Yes, I think the time is now. Obviously there are certain strategies, your particular situation comes into play. But I believe a few years back, our president at the time, Trump, he widened a lot of those tax brackets. So there are ways for us to detax a lot of that money now, especially being in that low tax bracket environment. So yeah, it's everyone's situation is unique, but now is a good time to start considering some of those options.
And Shane, Amy, you mentioned changes that have come to tax law and code, like the change in RMD age. Does this leave some available options and proactive strategies open for savers and investors?
I think it does. I mean, really not options, but it allows you more time. And so if you have more time, then you can make some better, more informed decisions. And so, if you've got an extra couple of years, yeah, it gives you an extra couple of years to maybe get some money from your IRA to your Roth, from your IRA to your investment accounts, or in some more sophisticated, plans and strategies. I mean, our national debt before this last $1.7 trillion package was about 29 trillion. We spend about 562 billion a year just servicing the interest. There's only two ways that we get that number down, right? The government either spends less money, which has happened in the past, unlikely, but it's happened. It's happened 4 times actually in the last 60 years. So it happens, just not often. The other way that they do that is they're going to have to raise taxes. And I mean, we've got a lot of spending going on. There's a lot of things that are happening right now. Right now at 37%, if you get $1 million in your IRA, you have about 600,000 after taxes. So if that goes up, if that tax rate goes up, that has an impact significantly, and that affects your life, your lifestyle. So yeah, I mean, going from 70.5 to 73, that's a big deal, not necessarily because there's some new amazing plan. It just gives you more time to execute a solid plan.
And Shane Swearingen, as you and Shane Amy are putting plans together for your clients, looking at the lifetime tax liability, helping your clients manage, control, and reduce that where possible.
Yeah, I mean, you can accumulate all the wealth that you want, but if it's not in the right areas and not the right buckets, and you don't have a strategy to start taking that money, you're going to leave it up to the government to decide for you, and no one wants to be there. I'll put it that way.
Tax is one of our largest known expenses in retirement, and where we do have the opportunity to control that, we probably should address that, visit that, educate ourselves proactively to try and manage it. And I know that is really part of the written income plan that you are putting together for your clients there at Shane and Shane Financial, right, Shane Amy?
Yeah, of course. Look, out of all the things that you can prepare for, so let's take healthcare, or the opposite end of the spectrum. that's hard to prepare for because you don't know when your health is going to decline, if it's going to decline at all. That's a very hard thing to prepare for. Um, Taxes, conversely, that's easy. I mean, that out of most of the majority of things you're going to face in retirement, taxes are by far the easiest thing for you to be proactive about. They're the easiest thing for you to prepare for. They're one of the easiest things to just put in place. Other things are out of your control. You might want to plan for this, but you don't know if that's actually going to happen. Taxes is one of those things. You just have to execute it. I mean, it's easy in theory. It's obviously a little more complicated to do, and I'll caution everyone before you start going out there transferring massive amounts of money. Don't stay, get with your CPA or your advisor. Stay within your limits, and just know the rules of the road, the rules of engagement before you go down this path. And if you do, and you take your time and you know that, you can get a bunch of money over into a tax-free environment. And that's, at the end of the day, I mean, that's what we're all going for. I mean, it's not that we don't want to pay tax. We just want to pay as little tax as possible.
And Shane Swearingen, to wrap up, as we are preparing to file our taxes for last year, is it also a good time and opportunity to look at forward tax planning for those years to come?
It's a great time. I will say this, Shane and I are not CPAs. We're not accountants. You have to surround yourself with the right team. If you don't have that accountant that you do feel comfortable with, Shane and I are happy to recommend and get you to the right people. But it all starts with having that right team around you. And yeah, I mean, as you're collecting and doing some of the last minute tax strategies and tax stuff, it's a great time for us to look at everything to make sure that you're capitalizing where you can.
Are there any particular strategies that you guys use like that you think is kind of unique, or are there any particular things that you are implementing with your clients right now, talking with your clients about opportunities for tax planning, keeping more of their money, things like that? I think
it's twofold. I mean, it really depends on where you're at and what your level of sophistication is, right? So, for most folks, just converting from a regular IRA to a Roth IRA, that's great. And if we can do that and get ahead of that over time, that typically works. For higher net worth folks, there are private placements, there's limited partnerships, there are conservation easements. Those are accredited investors. So, you need to be north of 400,000 in income or $1 million net worth outside of your home. For ultra wealthy folks, there are some very sophisticated plays, with life insurance. And, I'll swing that to Swearingen. That he's forgotten more about that stuff than I'll ever know. But I mean, on the other things, I mean, yeah, I mean, it's really a 3-tiered approach. And then that all depends upon, your level of sophistication, how many assets or how much assets that you actually have, and how much time you have to execute this stuff, and what your pain tolerance is. I mean, some people are like, yeah, it's a great idea, I want to do it, but I don't want to pay any more taxes now. And okay, well, I mean, you're going to pay them no matter what. Do we want to get it over with now or not? And so, I think those are the 3 tiers that Shane and I are familiar with, and that we are educated on and take our clients through.
So Shane, Amy, what I'm hearing is that there are 3 different tiers that you help plan for there at Shane and Shane Financial: taxes on income, taxes on accounts, and taxes on estates, all of which and each are going to have different strategies to help manage and control that tax liability.
Yeah. I mean, honestly, at the end of the day, Peter, there's probably 3 main tiers that we deal with, and probably in general. So you have, your folks that have gotten to, sort of the first tier. That would be, hey, I'm somewhere between, I'm somewhere north of $500,000 and, around $1 million, $1.5 million, $2 million. You've got to get as much of that converted over into either tax-free accounts or less taxed accounts that we talked about. So that'd be more like getting that money from a regular IRA, to a Roth IRA, or to a capital tax accounts, your mutual funds or your individual stocks. I think the second tier would be your higher net worth folks. Those are more advanced planning strategies that would be centered around, conservation easements, private placements, where you're getting to write off significant amounts of your income by using those sophisticated strategies. And then the third tier that we deal with, it would be like your ultra high net worth. So that would be like, 10 million and north of there. And that's typically where estate planning issues come into play. We're worried about estate tax, which is very heavy handed. And those, that we have premium financing, more sophisticated things that those folks can use and take advantage of to really help lessen the burden of those estate taxes. So no matter where you're at on the spectrum, we can certainly help you. We have experience doing that. We've been doing that. Not everybody out there, wants to do that, and not everybody out there can do that. And so, be careful as always, do your homework, do your research, but no matter what tier you fall in, there's something that you can be actively doing, because this is really easy to prepare for. You just have to go out there and do it.
Well, I think no matter where we are at, we always want to try to manage and control our taxes, and we've got to look at those opportunities. So, ladies and gentlemen, if you are not hearing about these opportunities, if you are not hearing about these strategies, pick up the phone, give Shane and Shane a call at Shane and Shane Financial, 888-300-3811, 888-300-3811. And let's get a handle on controlling those taxes, those income taxes, those accounts that are built up that are creating tax maybe we're not using for income, and then those estate taxes, all of those specific strategies that can be addressed and can manage and reduce your lifetime tax liability and your legacy and estate tax. So Shane and Shane here to help. They are your resource. Give them a call, 888-300-3811. Gentlemen, always a pleasure. Thank you for being here.
See you, Peter. Thanks.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fee-based financial planning and investment advisory services are offered through Truvestments Capital, LLC, an SEC-registered investment advisor.